Good afternoon, everyone. My name is Maurya Hanspal, and in this session, we're going to continue our discussions on mutual funds. So, in the previous session, we talked about the gold ETFs, silver ETFs, and the differences between keeping the physical gold with you as well as keeping it in the form of a gold savings fund. How to invest in an ETF by not directly investing into an ETF but through a gold savings fund that is ultimately a fund of fund. So, we try to understand these things. And in this session, we'll try to understand the Bharat Bond Exchange Traded Fund. So this was an exchange traded fund which was set up by the government of India. And instead of holding gold or silver or shares, it consisted of debt. And again, the debt would be benchmarked as per the debt value would be as per the benchmark index. And that is nothing but your bond index ke basis, the Indian bond index. So what exactly it is, the government had approved India's first debt exchange traded fund, Bharat Bond was its name, and comprising debt of state-run companies, a move that will allow the retail investors to buy government debt. So basically, like for example, you have the state-run companies, okay, like which are owned by the state government or the central government. Like each of these government have some stake within that. So if these governments, or sorry, not governments, if these companies are in need of urgent money, and these companies are the government-run companies, be it the state companies or the central companies. And if companies need the money, if these government companies need the money, as the same case in case of the other companies which are not owned by the government. When those companies also need money, either they come in the form of equity or raise debt. The similar concept goes in terms of the state-run companies or the government-run companies as well. Like for example, if those companies need some money, so these companies can come up with their own bonds and sell in the market, and those bonds would be available on the Bharat Bond Exchange. Okay, and we as the retail investors can buy the government debt. So ultimately, we have an opportunity to buy the government debt. And now, since it's a government debt, it would be secure because the government can't default in its payments. In the previous sessions, also we talked about the government securities or the gilt securities as we call them. We talked about the treasury bills. We talked about the treasury notes. We talked about the treasury bonds. So all these things we try to understand because those are the government backed and the government won't be defaulting on their payments. In case the government defaults on their payments, it can reduce the investors' confidence and faith on the government. And ultimately, even the foreign investors had also invested into these government securities for a safe return. Okay, so these things the government can't afford. The government will do everything, but it won't default on these payments. The only risk which the investor can face is only through the interest rate fluctuations. That's it. But from the part of the government in meeting its liabilities obligations, it is completely free. Okay. Now, the second point says it will be the first corporate bond ETF. Now, the other corporate bond ETFs have also come, but this was the first corporate bond ETF that came into place. Corporate means companies and company the state-run companies, which will provide additional money for PSUs as well as the other government organizations. The PSUs are the public sector units owned by the government on it. Like basically, at least 51% stake or more than 50% of the stake is by the government. Now, Bharat Bond Exchange Traded Fund will be managed by the Edelweiss Asset Management. So, government appointed the Edelweiss Asset Management, like one of the asset management companies, for where we talked about here, like the first one, right? So, it came with a Bharat Bond ETF. Now, ETF invest in a basket of securities representing an index, security, or commodity and are traded on the stock exchange. And this we all know. It will provide retail investors easy and low cost access to bond markets with similar amount as low as rupees 1000. The minimum amount that you can invest into these is 1000 rupees. Now, the government has so far allowed only equity ETFs, and the government raised nearly rupees 14,400 crores through ETFs in the 2019 to 20 fiscal year beginning April. Okay, तो गवर्नमेंट ने अलाउ करा सिर्फ इक्विटी ईटीएफ्स को स्टार्टिंग में, बट नाउ द अदर ईटीएफ्स हैव आल्सो कम इनटू प्लेस and nearly amount of 14,400 crores was raised. Okay. Now, Bharat Bond Exchange Traded Fund. Now, the retirement fund body employs Provident Fund. See, basically, your employer Provident funds or EPF as we call them, they want to keep the money of their employees as well as their employers safe. So, for the sake of simplicity, a large amount of money also goes towards government securities, your bills, bonds, and all these things, right? So that the government, basically, as I told you, like just the previous second back, the government won't be defaulting on their obligations. So that's why a larger chunk of money would also be contributed towards the government funds also. Because ultimately the company, it does not want to play with the employee's money, and it wants after retirement the employee gets a sufficient corpus. Now the Bharat key highlights की बात करते हैं. The Bharat Bond ETF will be a basket of bonds issued by central public sector enterprises or undertakings or any other government organization. Initially, these are the AAA rated bonds, and the AAA rated bonds are the best grade bonds. We call them as the investment grade bonds or the prime bonds, which won't default on their payments. The chances of default are very less in terms of just the corporate bonds, we can say, but in terms of government securities, the chances of default are almost negligible, zero. Now, Bharat Bond ETF will have a fixed maturity of 3 and 10 years and will trade on the stock exchanges. It will invest in portfolio of bonds of state-run companies and other government entities. It means the fixed duration or the majority of the bonds will be from 3 to 10 years. Okay. A Bharat ETF will track an underlying index on risk replication basis, matching credit quality and average maturity of the index. The index will be constructed by an independent index provider, National Stock Exchange. Again, as in the case of the stocks, it tracks the Nifty or Sensex. In case of commodities, it tracks the benchmark commodity index. Same in case of the Bharat Bond ETF, it will track the bond index. A Bharat Bond ETF will be enable deepening the corporate bond market with enhanced retail participation, because ultimately now the retail people can also participate in these things. Okay. Now, the expense ratio is 0.0005%. It's very less. Now, the bond ETF will provide safety. Underlying bonds are issued by CPSCs and other government-owned entities. Liquidity is there, and your tax-efficient returns are also there. Now, again, as I told you, the benefit is if you're like selling it after 3 years, then either you have the advantage of like 10% taxation or 20% after indexation or 10% without indexation. And what is indexation? We have talked about in the previous session. It takes into account the concept of inflation. Okay. Now, it says indexation is the process of adjusting the purchase price of an investment for inflation, which helps bring down the quantum of capital. Ultimately, the amount of tax that you would be paying would be less in this case. Now, you have the AAA rated bond, the highest bond rating that may be assigned to an issuer's bond. These are the prime bonds, and they won't default on the payments, and that is why they're called the AAA rated bonds. Now, Sebi examining feasibility of the corporate bond ETF. So basically, see, like Sebi was seeing that whether the corporate bond ETFs are good or not, because the government came with its ETF. Now, if the government has come up with the ETF, the other corporates would also be coming with their own ETF, and they would say that that our corporates can also raise money through those ETFs, because ultimately, like, you have also raised money. Okay, so these things can come into place, right? So that one thing is very essential in terms of getting to know that if the government is coming up with such bonds, the corporate should also be allowed to come up with such bonds. And that is one thing that must be clear into this case. Okay, and that was a scenario. Then basically what happened, the government, basically the Sebi, the Security Exchange Board of India, it started to examine the feasibility of the same. If they come up with the corporate bonds, will that be good or not? And now the corporate bonds have also come into play. Like they are also being traded on the stock exchanges. Okay. Now see, we have the net asset value concept. So before we go to the net asset value, let's try to understand one thing. When we talk about the net asset value, it is nothing but how much value is assigned to the particular units being given to you. As we calculate the different ratios, like in terms of share, we calculate the per unit value, right? We calculate the value of the share. That is the EPS basically, right? The profit by the EPS. So in case of the NAV, in case of the mutual funds, we calculate the NAV, the net asset value, because ultimately the mutual fund will also have like some of its assets. The mutual fund will also have some of its liabilities as well, and ultimately the units which are assigned to the mutual funds that have to be taken into consideration. And we'll be talking about and discussing about the concept of NAV